This recording is Sources of Finance, a very small introductory topic to finance for AS2. A source of finance refers to the way in which a business raises money or finance. Indeed, sometimes it can be referred to as capital that it needs for some activity within its business life. Generally, sources of finance can be classified in two ways: internal sources and external sources. Internal sources are actually sources of finance that already exist within a business, and it only means that you are making a decision about how to use that finance, that availability of finance to go about doing something. The three main sources of internal finance are the owner's own investment, retained profits, and sale of possible assets, some assets, and we'll come back to look at those in more detail. External sources of finance then, this is when an individual or a business or organisation, such as a bank or government, provide capital in some form to a business. Businesses are more likely to use external sources of finance when, one, they need a large sum of money to do something. Two, the level of risk associated with the source of finance is low, encouraging outsiders to invest or lend money. And three, the company's profit levels are relatively low, reducing the possibility of the use of retained profits. Two types of, the external source of finance can be classified into two categories. Generally, debt or loan capital, alternatively, equity or share capital. Of course, debt or loan capital is one that imposes quite a considerable amount of risk, and it is always repayable, whereas equity or share capital has less risk, indeed some risk to the investors, of course, but it is not deemed as repayable, so therefore is often referred to as permanent capital in the business. We're going to go through each of the sources, both internally, first of all, the three categories identified just shortly ago, looking at the benefits and limitations of these, and of course the purpose of why and how they're used. And then we will do the same for the external sources of finance, dividing them into both short-term and medium-term and longer-term in nature, and then looking at the pros and cons. So, internal sources of finance, first one being owner's own investment or capital. This is very often used in startup businesses, particularly sole traders and partnerships indeed. This is where the owners use their own monies, perhaps from savings that they've built up over a period of time, through their working careers, maybe even a redundancy payment received from an employer, and they want to use it to set up a business, or indeed they have inherited money and then are looking to invest their inheritance into business activity. The benefit is that there is no debt involved. There is no cash flow issues for repayments needed on a weekly or monthly basis. And of course, it does not attract any interest payments. The limitation of capital is that, of course, when you use capital to start up sole traders or partnerships, you do have unlimited liability, and the owners can lose, their personal investment that they put in. Second internal source, retained profits. The main purpose of using retained profits from within a business is obviously for growth and expansion. And of course, a business has to be existing and has built up a profit pool of money before you actually can access this source of finance in terms of retained profits. Because if you don't and have not earned profit, then you have no retention of money in the business to actually source to use. So these profits are that the business has made previously and have kept in reserve. The benefits is that there's, again, no debt, no repayments, and does not attract interest payments. So again, very similar to capital in terms of the benefits. The limitations are it only applies, of course, to existing businesses that retain their profits, and particularly in small business setup, it could be maybe a number of years before they actually build up a retained or reserves of profits So it can be a long period of time before sole traders and partnerships can access this type of source of finance. So it's restrictive. Thirdly, the sale of business assets. This involves selling off a particular type of non-current asset that is not going to be used again or used as frequently or has no real purpose any longer in your business. It increases cash injections quickly to your business, but the problem, of course, is that once it's sold and it's only a one-off source of cash injection. It doesn't give you any more revenue or cash coming in at any later period of time. So you dispose an asset that you no longer require, and maybe even property that you own or piece of equipment, piece of machinery, etc. It raises the finance quickly without requiring debt or interest charges. And the limitations is that, in fact, very few businesses, particularly small businesses, sole traders and partnerships, would have any assets ready to sell. In fact, everything that they actually own, they own it because they are using it and it's been purchased or hired or loaned out for the specific day-to-day running of the business. So external sources then, in terms of short-term sources, first of all. Short-term sources include bank overdrafts, bank loans, hire purchase and leasing, which are similar but have a few differences, and trade credit. So most of these words you will be familiar with, or concepts, because we cover all of these at GCSE theory on sources of finance also. Bank overdrafts provide short-term temporary finance. Their purpose is to assist in the day-to-day running of the business or buying in excess inventories. For example, in the run-up maybe to Christmas, where you're buying additional stock levels in the hope that that's your increased trading period, and you're advance buying your stock to have it ready, from sort of November sale time on. So you would maybe use a bank overdraft to do that so that you have the stock in, and then obviously when revenue starts coming, then obviously you're replacing that money back into your bank account again. Benefits are banks are more receptive to overdrafts as they are short term and confined to a certain amount a period of time. So for example, you might take out £10,000 for 3 months, or additional £10,000 to spend. It's not yours, it's the bank's. And then obviously you have to recoup that money back to the bank again. Limitations are interest rates are higher than normal loans, and banks can recall the full amount at any time. And there are large penalty fees or charges by the bank if the overdraft amount is exceeded. So if you try to draw down more than the £10,000, even £100 or even £50 more, that's when the very high interest rates will kick in. Bank loans then are an amount of money loaned by the bank with an agreed interest rate and specified monthly repayments over the period of the loan, period of time that you take the loan out for. Most loans are generally short-term in nature and are rarely refused by banks. And so long as you have a positive, realistic business plan to present when you approach a bank for a bank loan, it is likely that you will receive it. But again, the more risk involved from the the bank's perspective, the higher rates of interest that you can be charged. And of course, any bank loan that you seek to borrow, you must secure collateral against it. That means property or assets of value in your business against it, so that if you do default on your payments, then the bank has some security to be able to take assets from you, collateral from you to sell, to retain the money they have borrowed you. Excuse me. The benefits: the business keeps its ownership and control intact while the loan is being repaid, and the interest rate is fixed and cannot be changed even if the market interest rates go up or down or over the life of the loan. However, the limitations can be expensive. The banks decide on the loan interest rate depending on the risk and available collateral, and failure to repay loans, of course, is a liquidity problem and can cause businesses possibly to fail through poor cash management. And again, most banks require collateral to protect themselves against the money they loan out to you. Okay, so hire purchase and leasing. These are kind of a similar arrangement, only slightly different towards the end of the borrowing period of time. So first of all, hire purchase, if we think of the word, you're hiring it before you eventually purchase it. Okay, and this is normally a external source of finance provided when you are requiring the purchase of an asset, buying an asset. So for example, vehicles, even a company fleet of vehicles, plant, machinery, even large computerized equipment, computers, a computer network of systems, etc., large infrastructure, etc., IT infrastructure into your business. So a finance loan is given to you by a lender, okay, that pays the full amount of the purchase asset to the retailer or to the business on your behalf as a business. And with the business repaying the full loan plus then an agreed rate of interest back over a period of time. So the benefits are it allows your business to purchase assets without having the full finance immediately yourself and your bank to hand over. And the business pays a small deposit. So you pay a small deposit and you pay the balance monthly over a period of time, normally about 3 years, with probably competitive enough interest rates. But the asset belongs to the business, okay, that has sold it to you, okay, or leased it to you, or hired it to you on final payment, until final payment. The lender can repossess the asset if monthly repayments are not met. That's the limitation, and the value of the asset decreases over time with depreciation, and with final payment, the asset's value is significantly reduced. So it's very likely that you pay, say, initial deposit, and the deposit could be maybe, say £2,000, and then your monthly payments over maybe a 3-year period could be £400 or £500 a month. But coming towards the very last month of the contracted period, say 3 years, 36 months, you might have a final figure to pay of £2,000 again, or £3,000. And in fact, when you add up what you've paid out over the 36 months, the total amount paid back might say come to £16,000. That's inclusive of interest. And in fact, in that last month, if the asset were to be sold, okay, if it was your asset to own in the first place all along, you decide to sell it, then it may not be anywhere near worth £16,000. So it loses value obviously over time with depreciation. But the point is, when you make your last payment, the asset is yours now to own, and then you are free to do what you want with it, sell it on, etc. Leasing is similar to hire purchase, but the main difference being that after the period of leasing, the asset is returned back to the leasing company, the lender. Okay, so at all times during the leasing period, the leasing company retains ownership. What's the benefits of this? Well, it allows business to purchase the assets without having the full finance immediately to hand. So similar to hire purchase. The business is leasing the asset until no longer required, and therefore it can be replaced and updated. So it's a kind of win-win. You're never going to own it, but it works very well with assets that have a very short life, or they get a lot of wear and tear and a lot of depreciation. And in fact, after 2 or 3 years, you will be replacing the asset anyway, even if you bought it outright at the start. So leasing works very well for companies that do not want to hold on to assets for very long periods of time, or in fact it's not conducive for them to do so because they've lost too much value and they've worn out or become out of date anyway, because the type of asset is technologically developed and updated every few years. So you are basically leasing it for a period of time, getting its use from it, and then at the end of your contract at 2 or 3 years, off it goes back and you're updating with another one, and you probably off you go and follow a new leasing arrangement. This would be very, very common with things in large companies where they maybe have work mobile phone contracts, photocopiers, for example. In large organisations, a lot of admin, certain types of machinery, again, that needs to be updated, plant, etc. And indeed, company vehicles would be very, very common where leasing arrangements are used. Okay, disadvantages is that if the asset if it's a long period of time of a lease, then obviously what you've paid back for the lease over the period of time can be quite expensive, because obviously you're paying interest on monthly payments. And if you'd bought it outright at the start, the company vehicle might cost you 15 grand to buy it at the start, but leasing it over, say, a 4 or 5 year period, you might actually have paid back £20,000 on the vehicle. And of course, at the end of the 20 years, okay, the vehicle is nowhere near worth £20,000. Okay, trade credit then is the last one. This is very common in business-to-business arrangements. Suppliers are allowing their customers, so in other words, a business to a business, okay, suppliers a business, the customer is also a business, additional time to pay their goods from the normal 1 month to 2 to 3 months trade. So you go, you pick up your supplies, your finished goods, your raw materials, component parts, you use them, you add value, you trade on, and you sell your product on to your customer. You accept and receive your revenue, and then you pay back your supplier. So trade credit acts as an assistance to cash flow management. Get the money in first before you pay the money out. So the business has inventory sold and money is received prior to paying the supplier, which obviously aids cash flow, and that's the key benefit. Limitation: supplier can renew trade credit agreements and reduce the time period, anything from 3 months backways. If, for example, if they're experiencing cash flow problems, they may call in their money to you quickly, and you need to have enough cash to be able to pay that. So that can cause then you to have a cash flow issue if you have got to repay at short notice. Okay, medium-term sources of finance then include factoring, sale and leaseback, and venture capital. So we'll go through these 3 concepts. Factoring: this is where the business sells its monthly trade receivable sales value to the bank, which basically pays the full amount, less its fee, 30 days before the invoice is payable, and the debtor pays the sold invoice amount in full to the bank at the end of the month. So the benefit is that the business does not have to wait 30 days for a trade sales invoice to be paid. And this is business to business, again, arrangement. That allows them to improve their cash flow as the business receives monies at least 30 days earlier than expected. So just to summarise that, really what's happening here is, so if you're a trade to trade business and a lot of your customers, your business customers, are all in trade credit with you, and they owe you a considerable sum of money over the period of 2 to 3 months, and you need to keep them, giving them trade credit, or else you lose them as customers. But if you're experiencing cash flow problems as a business, or indeed you have to invest or you have to spend money in some way, and you've no access to cash because your cash has not been given to you yet, you could sell off your debts, as in what's owed to you, okay, that you haven't got yet from your customers. Sell off those to a factoring company, which very often is a bank or a financial institution. What you're doing is they're injecting you with the cash that's owed to you by your customers. They're giving you that now in the here and now, so that you can use that money to continue operating and improving your cash flow. But they do that at a fee. So in other words, they're going to take a slice out of that amount of money. And then when the cash is returned, okay, to you by your trade partners, your businesses, and comes into you eventually after 60 days or 90 days, you then are paying back the factoring company the money. But remember, they have taken a slice, okay, of a fee from you. So you're not getting money borrowed to you easily. There's a cost to that, which then is going to obviously cut into profitability of your business. Okay, so factoring really probably works on large business scale operations where there is a significant amount of trade credit arrangement going on. Right, sale and lease back then. What would you have to sell that you could possibly lease back? So this is all about assets. So sale and lease back is essentially swapping an asset. Okay, our land, maybe, or a building, for cash, and adding long-term leasing liability for the same asset. So the business sells its premises, for example, for the full value, and then rents it back again from the new owner, okay, at a realistic rent. So what would that be about? Again, that is an injection, a huge injection of cash as a one-off. But you still need to use the asset. You still have to use the asset to operate, but you need a cash injection of the value of that asset. So sell it off to someone that's going to give you the cash injection, and then you are leasing it back off them again. And of course, then they're getting a percentage on that lease, and that's how they make money back from you. So the sale of the premises releases the major funds, enabling the business to use the money to do what they want to do, probably expansion or growth. There's no repayments or no interest, and you earn no interest, and you earn interest on the deposits. The rent is now payable to the new owner, reducing your profits, of course, overall, and the new owner, of course, that owns the asset can increase the rent, in this case, because it's premises or indeed whatever asset it is, they can increase the amount that they're charging for the lease back, at any time. And the last and third one of medium-term external sources of finance is venture capital. Venture capitalists tend to invest at a very early stage in business, particularly high-risk startup businesses. Venture capitalists, provide finance in return for a percentage shareholding in a company. They share the control of the business with the directors. Now, best example of this is where maybe you watch Dragon's Den and you see people come to pitch an idea, and maybe it's a high-risk business proposal, but it has huge potential in terms of profitability if it is managed well and gets a marketing strategy right, etc. And you'll see the dragons who would be deemed venture capitalists in some respect. Some of them are deemed as that, some of them may be business angels, that they are going to grab hold very quickly of this idea and inject finance because they want a piece of this new idea, this potentially very profitable venture. As a shareholder, the venture capitalist strives to increase the company's profits and the dividends, while the value of the company and the shareholder share price increases. Venture capitalists sell on their shareholding to others when they have reached their target returns, normally up to 5 years. So venture capitalists are people that are not long-term investors. They come in quickly, get businesses up and running. Their key quality is they have access to capital. They're injecting their capital, and they probably use their expertise and know-how to support the business till it's on its platform or trajectory of profit earnings, and then they withdraw, move on to another venture, a new venture or a new idea. Long-term sources of finance then include mortgages, share capital and debentures. And mortgages is a very familiar term. As we know, a mortgage is money that is financed against the collateral of property over a very long term. So it's money secured against the value of the asset. Commercial mortgage is a long-term loan to purchase land, or indeed premises, or indeed to erect a new building, new factory, new warehouse, new office block, etc. The large loan is normally long-term, ranging maybe from 20 to 40 years to repay back again, depending on the size of the loan. So, of course, these can incur fairly high interest repayments. It is possible for the total loan repayments to actually double that of the original mortgage, depending on market interest rates. So that's the biggest difficulty, and you'd see this sometimes quoted. If a person borrowed 100 grand to purchase a house, now you wouldn't get a house for 100 grand now, but if they had years ago, bought a house at 100 grand and took a mortgage out over 25 years, what would you have paid back at the end of 25 years? You could have paid back £200,000 to the bank. So that's how the banks make their money. That is how their profit earnings, although they wait a long time for their money to come back, they are hugely successful in what they are getting back on each loan. So, the property was 100 grand to purchase and they've earned £200,000 back on it. Share capital, we know, is involved with limited companies, LTDs and PLCs, and this is where the share issues are made, particularly in PLCs on the stock market, and investors, if you have the capital, purchase shares in exchange for share holding. In LTDs, as we know, are family and friend businesses. There has to be an agreement between share ownership and the conversion of shares between owners, etc., and they cannot sell their shares on the stock market. What is very important is that there's no interest, there's no repayments. This is all the permanent capital. Share capital is permanent capital. So it's not repayable in full, but however, when businesses are doing well, you do have to repay, okay, out in terms of dividends. You have to give a reward back to your shareholders. That's what they're invested for in the first place. And again, ordinary shares and preference shareholders will then get paid differently based on the success of the business yearly and in terms of what ownership they own when they first invest. Debentures are large public limited companies can obtain finance by issuing these types of long-term loans to parties who are not shareholders of the company, and the debt can be sold to other parties. So a debenture is a bond basically, or a long-term loan. It's a fixed rate of interest is paid throughout the debenture period, and future cash flow commitments are known in advance. Debenture loans are more secure than investing shares in the company. The debenture interest is payable irrespective of where the company makes a profit or loss, however, and a debenture holder is guaranteed a return in the form of interest payments compared with a dividend payment to a shareholder, which is not guaranteed. Now, there is a significant amount of theory in this section in terms of just all the different types of sources of finance. Internal, first of all, is fairly straightforward. So just to recap, capital, owners' own capital, retained profits, and sale of business assets. That's the internal. The external then are all the ways you source money from outside of your business, okay? And then you can split them into short-term, medium-term, and longer-term access to finances. Okay, now, what you have to remember in answering a question on sources of finance is that it is all based on the context of the business scenario that you are reading. So, if you are asked to analyse 3 sources of finance or evaluate what sources of finance the business should be accessing, whatever, you can't just pull 4 or 5 or 3 or 4 sources of finance out of your head that you've learnt in theory. All of those we've just gone through. You need to think about what the business needs the money for. Is it short term? Is it a longer term venture? What's the risk involved with what they need the money for to do? So if it's high risk, is it? Are you going to source debt sources of money when it's a high risk venture, and then one of your venture doesn't pay off and you've all that repayment to make plus interest? So you have to match up, what is the money needed for and what's most applicable, okay, for the business, okay, to do. Okay, so just be careful when you're reading your case study that you're identifying what's its needs and looking at its current cash position and even its profitability position and its ownership, etc. Because all of that will help you make a better decision on what to suggest as the appropriate, sources of finance to use.